Let me show you how a $250,000 reverse mortgage balloons into over $500,000 of debt against your home. And get this, it's not because you missed a payment. It's not because you borrowed a single dollar more. It's because the loan is designed from day one to grow like this. The commercials sell you this dream of a payment-free retirement, but they conveniently leave out the math that's happening behind the scenes. And that math is the difference between leaving a legacy for your family and leaving them with nothing but a bill. Let's walk through the one detail that almost everyone misses. Look, on the surface, this product sounds incredible. A reverse mortgage, usually a home equity conversion mortgage, or HECM, is a loan for homeowners 62 and older, and it's insured by the FHA, which sounds safe, right? And the promise they sell you on is powerful. 0 required monthly payments. If you have a mortgage, poof, it's paid off. If your home is free and clear, you can pull out cash without a new monthly bill. You still own your home. The title stays in your name. The catch? The loan comes due when you sell the house, move out for good, or when you pass away. They even make you go through mandatory counseling before you can get one, which makes it all feel extra legitimate. And to be clear, this is a legitimate financial tool. But just because something is legit doesn't mean it's a good deal. If you're smart, you don't just look at the sales pitch. You have to ask the most important question. How does this thing actually behave over time? All right, so there are basically 3 ways they'll give you the money. First, the lump sum. You take all the cash at once. The problem? Interest starts compounding on the entire amount instantly. Second, a line of credit. This is more flexible. You only draw what you need, and any unused credit can grow over time. And third, 10-year payments. This is like getting a monthly paycheck for as long as you live in the house. Now, each one of these feels different in your bank account, but none of them change the dangerous math underneath. And this is where people get tripped up. They get so focused on the cash coming in, they completely forget to look at how the debt is piling up. Okay, stop. This right here is the most important part of the entire video. This isn't a decision about your cash flow today. It's about the cost of compounding tomorrow. That loan balance isn't just sitting there. It is actively, aggressively growing every single month. And that growth is what decides if your house is an asset you can pass on, or if it just becomes collateral for an ever-expanding loan. Serious retirement planning means looking at the trajectory, not just the immediate benefit. By the way, if you'd like a reverse mortgage calculator, there is a link in the description to my own reverse mortgage calculator. So here's the detail they bury in the fine print. Your loan balance isn't just growing from interest. It's growing across 4 separate layers of costs. 4. First, the financed closing costs. Reverse mortgages have insane upfront fees: origination, appraisal, title, and more. We're talking $10,000 to $40,000. And guess what? Most people roll that right into the loan, which means you start paying interest on the fees themselves. Second, the upfront FHA mortgage insurance. This is a mandatory 2% premium on your home's appraised value. On a $500,000 home, that's another $10,000 fee tacked onto your loan from day one. And yes, you're paying interest on that too. Your loan doesn't start at 0. It starts in a hole. Third, the annual mortgage insurance. This is another 0.5% of your outstanding balance, added every single year. And since your balance is always growing, this fee gets bigger every single year too. It's a fee that feeds on itself. And finally, fourth, the actual interest. It gets charged on the cash you took out, the closing costs you financed, the upfront insurance premium, and all the annual insurance fees. It is a compounding machine running on everything. When you stack fees on top of fees like this, the growth isn't slow and steady. It's exponential. Let's run the numbers on a real-world example so you can see how fast this gets out of control. Let's say we have a couple, both 68 years old. Their home is worth $600,000 and it's paid off. They decide to take a $250,000 lump sum. But after you add, let's say $15,000 in closing costs, and $12,000 in upfront mortgage insurance, their starting balance on day one isn't $250,000. It's $277,000. They're already $27,000 in the hole before they've even spent a dime. Now let's assume a 6% interest rate plus that 0.5% annual insurance for a 6.5% effective growth rate. After just 5 years, that balance has grown to about $380,000. After 10 years, it's closing in on $520,000. And by year 15, the balance is now over $710,000. They didn't borrow another dollar. They didn't miss a single payment because there weren't any. The loan just did exactly what it was designed to do. This is the projection you have to see before you sign anything. Because by year 10, that number looks very different. And by year 15, it can exceed what your house was originally worth. That is the trade. Liquidity today in exchange for your equity tomorrow. Okay, but what happens if the loan balance grows to be more than the house is worth? The loan officer will tell you not to worry because it's a non-recourse loan. And what that means is that you or your heirs will never have to pay more than the home's final sale price. If there's a shortfall, the FHA insurance fund covers it. But here's the critical distinction everyone misses. A non-recourse clause protects you from debt. It does not protect your equity. If the loan balance eats up all the value in your home, there is nothing left. Zero. Non-recourse just means your kids won't get a bill for the difference. It doesn't mean they'll get an inheritance. That's a huge difference. By the way, if you're getting any value out of this breakdown, do me a favor and just destroy the like button for the YouTube algorithm. It takes a split second, costs you nothing, and it helps get this information out to more people who really need to see it. So when do you actually have to pay this thing back? There are 3 main triggers. First, you sell the house. Simple enough. Second, the last surviving borrower passes away. Or third, you permanently move out. And permanent usually means you're gone for 12 consecutive months. So if you move into an assisted living facility, that clock starts ticking and the loan can be called due. And this is so important. During the entire life of the loan, you are still on the hook for property taxes, homeowner's insurance, and all the maintenance. If you fall behind on your taxes or insurance, the lender can foreclose on you. Let me repeat that. Even with a reverse mortgage, you can still lose your home to foreclosure. No mortgage payment absolutely does not mean no expenses. Look, after all this, I want to be fair. A reverse mortgage isn't automatically a terrible idea. It's a very specific tool for a very specific person. It could make sense for someone who is house rich but cash poor and is planning to live in that home for the rest of their life. Or someone who wants to get rid of a huge mortgage payment they can't afford. A standby line of credit can also be a smart way to avoid selling stocks in a down market. For these people, it can be a lifeline. But it is an awful idea for a lot of other people. If you think you might move in the next 5 to 10 years, those massive upfront costs will eat you alive. If you're already struggling with taxes and insurance, this loan will just put you on a fast track to foreclosure. And obviously, if your main goal is to leave your home to your kids, this is probably the worst way to do it. Think about it. You have 3 basic ways to get equity out of your house. You can sell it. You lose the home, but you get all the cash. You can get a HELOC or a cash-out refi. You keep the house, but you get a new monthly payment. Or you can get a reverse mortgage. You keep the home and have no payment, but you activate this incredibly expensive compounding debt machine against your own net worth. None of these are free. They're just different ways of pricing risk. So before you even think about signing the papers, you need to demand one thing from the loan officer: a complete year-by-year amortization schedule. Then, ignore the first few years. Go straight to the column for year 5. Look at the balance. Then go to year 10. Look at that balance. Then go to year 15. Then you have to ask yourself one simple question. Am I okay with this number? Am I truly comfortable watching this much of my equity evaporate into debt? If the answer is yes, then at least you're going in with your eyes wide open. You understand the trade-off. But if the answer is no, then you've just saved yourself from a massive financial mistake before it's too late. At the end of the day, a reverse mortgage isn't a scam. It's just a very, very expensive way to borrow money. The real danger isn't that the lender is lying to you. It's that most people don't understand the destructive power of compounding interest when it's stacked with all these fees. This is not free money. It is not a government benefit. It's you paying to access your own equity at an incredibly high price. And the real question isn't just whether the loan works as advertised. It's what happens when the assumptions in that amortization schedule, like interest rates and home values, don't hold up. That requires an even deeper layer of analysis. And in the next video, we are going to tear apart the 5 biggest myths people believe about reverse mortgages to see which ones are actually true. Clarity beats comfort, every time.